Two families, one country in 2008, Canadians watched the U.S. housing market collapse on TV and mostly walked away untouched. But fast forward to 2026, meet Alex and Elysia, a young family in the Greater Toronto area. In 2022, they bought their first home near the peak of the market, in a modest house for $1.2 million. They stretched their budget, locked in a 5-year mortgage, and told themselves something millions of Canadians believed: Canadian housing doesn't really crash. Now their mortgage renewal is approaching. Their monthly payment is about to jump by hundreds of dollars. And the same house they bought in 2022 is now worth about 20% less. For families like Alex and Elysia, the question isn't whether the banking system will collapse. The question is much simpler and much scarier. What if 2026 is actually more dangerous for Canadian households than 2008 ever was? Let's break down what's happening. Why this time feels different. Back in 2008, Canada's housing market slowed, but it didn't implode like the United States. One major reason was lending standards. In the US, roughly 25% of mortgages at the peak were considered subprime. In Canada, it was closer to 3%. Canadian banks stayed stable, and the financial system held up. But something important happened after that crisis. Instead of deleveraging, Canadians borrowed more. Home prices kept rising for more than a decade. Interest rates kept falling, and cheap money made large mortgages feel normal. By the early 2020s, Canada had the highest household debt-to-income ratio in the entire G7, over 180%. That means Canadian households owed about $1.80 for every dollar of after-tax income. For comparison, the United States was closer to $1. So heading into the current downturn, Canadian households are far more leveraged than they were in 2008. And that leverage changes everything. Driver number one, the household debt bomb. Let us start with the biggest structural risk in the system: household debt. Today, Canadian households still carry roughly $1.70 to $1.80 of debt for every dollar of disposable income. Most of that debt is mortgages. By 2025, mortgage balances in Canada were estimated at around $2.3 trillion. The problem isn't just the size of the debt, it's when that debt was taken on. Millions of mortgages were issued when interest rates were incredibly low, often between 1% and 2%. At the same time, home prices surged far faster than incomes. In some major cities, the price-to-income ratio reached double digits. That means households were taking on enormous leverage to buy homes whose prices were historically stretched. This system works as long as two things stay true: interest rates remain low, and home prices keep rising. But in 2026, neither of those assumptions looks guaranteed. Driver number two, rate shock and the mortgage renewal wave. The second major pressure point is timing. Between 2022 and 2023, the Bank of Canada raised interest rates aggressively from near zero to around 5%. Even though rates have eased since then, they remain far above the emergency levels Canadians became used to during the pandemic. As of early 2026, the policy rate sits around 2.25%. And that's where the mortgage system creates a delayed shock. Most Canadian mortgages renew every 5 years, which means millions of loans written during the ultra-low rate period of 2020 to 2022 are about to reset. Roughly 60% of all Canadian mortgages will renew in 2025 and 2026, and many of those borrowers originally locked in rates around 1.5% or 2%. When those mortgages reset, the monthly payment changes immediately. Bank of Canada estimates suggest that a majority of borrowers renewing in this period will see higher payments. Average mortgage costs could rise about 10% in 2025 and another 6% in 2026 compared with late 2024. For many 5-year fixed borrowers, the increase could reach 15 to 20%. This isn't the kind of crisis that starts on Wall Street. It's the kind that starts at the kitchen table. Families sitting down with a calculator asking questions like, do we cut back spending? Do we sell the car? Or do we sell the house? Driver number three. Prices are already falling. The third piece of the puzzle is home prices themselves, because the correction isn't hypothetical anymore. It has already happened in several markets. Nationally, real home prices have fallen roughly 20 to 25% from the 2022 peak. that makes this downturn deeper than the roughly 10% decline Canada saw during the 2008-2009 crisis. In the Toronto area, prices have dropped around 21% from the peak. The deepest housing slump there since the 1990s. Average selling prices are still far below the roughly $1.33 million high reached in early 2022 in Metro Vancouver. The benchmark price sits about 12% below its April 2022 record. For homeowners who bought recently with small down payments, say 5% or 10%, that kind of decline matters a lot because it can push them into negative equity. That means the mortgage balance is higher than the home's market value. Combine negative equity with higher mortgage payments at renewal, and you create the conditions that often trigger forced selling. And forced selling is what can keep a housing downturn going longer than people expect. 2026 versus 2008. What's worse? What's safer so? Is 2026 really worse than 2008 for Canada? The honest answer is, it depends on what part of the system you're looking at. For households, several things are clearly more challenging today. First, debt levels. Canadian households are far more leveraged than they were before the financial crisis. Second, valuations. Home prices continued climbing for another decade after 2008, pushing affordability to extreme levels in several cities. And third, the mortgage renewal shock. In 2008, most borrowers were not rolling off 1% mortgages into rates 2 or 3 times higher. In 2026, millions of Canadians are doing exactly that. But there are also important stabilizers. Canada's banks remain heavily regulated and well-capitalized. The country also introduced mortgage stress tests, requiring borrowers to qualify at rates higher than their actual mortgage rate. Those policies reduce the chance of a US-style banking collapse. So the likely outcome looks different from 2008 in America. Not a sudden financial meltdown, potentially years of pressure on household finances, lifestyle cuts, slower spending, and a long adjustment period. How to protect yourself in a housing downturn. So what can Canadians actually do about it? First, stop thinking of your house as your entire retirement plan. If most of your wealth sits in one leveraged asset in one city, you're not really diversified. Gradually building investments outside housing like broad stock ETFs, GICs, or bonds, depending on your risk tolerance, can reduce that concentration risk. Second, prepare early for mortgage renewal. If your mortgage renews in the next few years, start planning now. Compare lenders early. Run your own budget, assuming rates 1 or 2% higher than today. Treat extended amortization as a last resort safety valve, not a lifestyle upgrade. Third, maintain a real emergency fund. Ideally, 3 to 6 months of essential expenses and cash-like assets. And that fund should not rely on borrowing against home equity. Fourth, if you're renting, don't panic about timing the market perfectly. The goal is not buying the absolute bottom. The goal is buying when your income is stable, your down payment is strong, and the monthly costs still make sense even if rates move again. Finally, investors should de-risk the most fragile strategies first. Highly leveraged pre-construction speculation and negative cash flow rentals that rely entirely on rising prices tend to be the first dominoes in long downturns. None of these steps guarantee profits, but they dramatically increase the odds that you survive a housing slump without blowing up your finances. Canadian housing has gone through major downturns before: the early 1980s, the 1990s, and the global financial crisis. Each time, the system survived, but the recovery often took years. The people who suffered the most weren't the banks. It was ordinary households that took on too much debt at the wrong time. In 2026, Canada's financial system still looks stable, but Canadian households are more stretched than at any point in modern history. You can't control interest rates. You can't control housing prices. But you can control how much leverage you take on and how diversified your finances are. If you want more simple breakdowns of Canadian housing, banking, and personal finance, subscribe to True North Invest. And check out the next video on how Canadian banks quietly keep customers paying unnecessary fees because during a housing downturn, every dollar matters. Thanks so much for watching. If you found this helpful, be sure to hit that like button and subscribe for more content on personal finance in Canada. See you in the next video.